Today, Bitcoin climbs back above $95,000. The Fed says it's pulling its bank guidelines for crypto-related activities. And Alex Grishman with Haynes Boone breaks down the rising trend of crypto margin lending among institutions. Welcome to CNBC's Crypto World. I'm Talia Kaplan. Digital currencies are moving higher as we head into the weekend. By noon Eastern, Bitcoin, Ether, and Solana all rose more than 2%, with Bitcoin trading back above the $95,000 level for the first time in nearly 2 months. Looking at the past week, major cryptocurrencies posted their biggest gains of the year so far. Bitcoin rose more than 12.5% for its best weekly performance since the middle of November. Ether jumped 13.5% and had its best week since December. And taking a look at crypto-related stocks, they're also posting big gains this week on the heels of a Wall Street comeback. Coinbase and Robinhood both soaring more than 18% since last Friday, while Strategy rose 15.8% and Mara Holdings jumped 12.8%. The S&P, meanwhile, was on track to close the week nearly 4% higher. Okay, let's talk about the top stories. U.S. banking regulators announced they're pulling back some guardrails tied to crypto and stablecoin activities. Yesterday, the Federal Reserve Board said it was withdrawing a pair of supervisory letters, including one stipulating that banks give advance notice of planned or current activities tied to crypto. On top of that, the Fed joined the FDIC and Office of the Comptroller of the Currency in withdrawing a pair of statements related to the crypto exposure and activity of banks. The Fed said the board will work with the two agencies to decide whether more guidance to support innovation, including crypto activities, is needed. The new changes from the Fed come amid a much friendlier crypto environment spearheaded by the Trump administration. Last month, the Office of the Comptroller of the Currency became the first U.S. regulator to make it easier for banks to engage in crypto activities. The banking regulator scrapped guidance adopted under the Biden administration, which urged banks to be cautious when getting involved in crypto. Next, Fidelity says public companies are increasingly buying Bitcoin from exchanges. The digital assets arm of the TradFi giant shared on X that it has seen Bitcoin supply on exchanges dropping due to public company purchases, and added that the momentum is expected to accelerate in the near future. In a follow-up post, Fidelity shared that there are 2.6 million Bitcoin on exchanges, which it says is the lowest number since November of 2018. It also highlights that public companies added nearly 350,000 Bitcoin in the aftermath of the 2024 presidential election, along with more than 30,000 Bitcoin per month this year. Of course, Bitcoin touched new highs after the election in the hope that Trump's presidency would usher in a friendlier stance on digital assets. Strategy stands as the largest corporate holder of Bitcoin, with a holding of 538,200 tokens as of this past Sunday. Last month, GameStop announced it would also add Bitcoin to its balance sheet. And just this week, we learned of a new Bitcoin native company, 21, which would be supported by members of the TradFi and crypto industry. That firm holds more than 42,000 Bitcoin and plans to offer investors a singular vehicle for Bitcoin exposure. All right, for our main story, Crypto World's Tanea McKeel spoke with Alex Grishman, a partner at the law firm Haynes Boone, about trends in crypto margin lending. He says more Bitcoin investors are borrowing against their holdings and that he's seen growing interest from institutional lenders and banks to get into this practice.
Alex, thank you so much for joining me on Crypto World today. Crypto margin lending is this idea that investors can access some of their wealth tied up in Bitcoin holdings. So what has the trend been like in recent months toward this strategy, especially with the run-up in prices since last year?
Yeah, so certainly the trend has been for more borrowers to be looking to borrow fiat currency against Bitcoin for a number of reasons. We've seen it historically in the first quarter. People will borrow against their Bitcoin to make, tax payments or other things like that. People are also looking to borrow to buy real world assets. People are buying homes, cars, whatever it might be, and they don't want the tax consequence of selling their Bitcoin. Right, they'd rather borrow against it, make the investments or purchases that they want and pay back the loans. So that's kind of the same trend we've seen in the Q1s of prior years as well.
One thing we heard from Haynes Boone ahead of this interview is that your lawyers were seeing big banks getting more involved with this practice. So what does that look like, and how involved are they?
Yeah, so we're seeing the first. We've talked to the banks about it for a long time. I come from the traditional world of finance, of representing banks when they're lending to hedge funds and private equity funds. against like, liquid securities, things that you would see in the S&P 500. But now banks are starting to dip their toes into this same marketplace in the same way they would lend against securities. They're not doing it directly yet, but some of the lenders, like Arch Lending, as an example, has a new securitized portfolio of loans against BTC, and some of the institutional lenders are looking to products like that to dip their toes into a portfolio of loans that are secured by Bitcoin. So that, I would say, is kind of like the first iteration that we're seeing from institutional lenders and in some cases banks to look at this product.
And what's the benefit for the banks? And if you could also, touch on the risks for them given crypto's volatility.
Yeah, well, I mean, certainly the banks, the interest rates on these loans are substantially higher, I would say, than home loans, car loans, commercial loans that are in the marketplace. Even if interest rates are generally higher against all those products, interest rates that you can charge against cryptocurrency-based loans, whether it's Bitcoin-backed, Ethereum, Solana, whatever it might be, those interest rates are a little bit higher, or certainly higher than what commercial banks are seeing in other products that they're lending against. The risk obviously is the volatility. We've seen it historically with Bitcoin and Ethereum and these other assets, that the value of Bitcoin and Ethereum can drop significantly in short periods of time. And, like it happened in 2022, to the extent that does happen, some of these lenders can be, caught a little bit short to the extent they're slow on making margin calls or otherwise liquidating assets against these loans. So, the risk of the volatility, I'd say, is number one.
On the regulatory front, obviously, we are in a much looser environment than we were in previous years. Is that a risk for banks getting involved in margin lending? And what would you say are the rules right now?
Well, certainly the regulatory landscape is changing. I know that everyone talks about it being looser right now, but I would say it really, the dynamic is changing where people are not as fearful of regulation by enforcement. We keep hearing that phrase. I think the banks are very well acclimated to the idea, internally, of kind of regulating the assets they're going to lend against and kind of understanding the risks. And I think the kind of conservative approach they're taking to these products and these new loans, I think that's the right way for them to do it. They are large institutions. They have to get their in-house lawyers. They have to get their credit groups to kind of sign off on them. So I think, kind of with the internal safeguards that they have, they're well positioned to kind of slowly enter the marketplace to the extent they want to do that.
And so on that, how are you advising clients about this business and how are you telling them to get involved?
Yeah, so it is kind of like the first step are some products like, we were talking about against, like with Arch, where they have, this securitized portfolio, of loans. Some banks and some non-bank lenders have started to lend against Bitcoin directly. But it's the same thing like when we tell them about lending against hedge fund interests or portfolio or other, kind of non-standard collateral. We have to explain to them how to perfect their security interest. We have to tell them about regulatory risks, what your counterparty looks like, some, risks in the documentation, or in the case of cryptocurrency, some underlying technology risks that there might be. And then we also have to game plan for them, what an exit from one of these loans would look like in a downside scenario. And, it's the same discussion that we have with other, underlying collateral. It's just, this time we're talking about cryptocurrency rather than, LP interest, limited partnership interest in a hedge fund or, a portfolio of public securities. It's just kind of what the exit looks like is just different.
Before we go, we want you to know the SEC is hosting another crypto policy roundtable today. This one is focused on crypto custody rules. This event is the second of 4 roundtables hosted by the agency's crypto task force with the goal of discussing recommendations for digital asset regulation. We'll have highlights from that roundtable in Monday's show. Well, that's all for Crypto World this week. We'll be back again on Monday, and we'll see you then.